As Warren Buffett said, accounting is the language of business. And unfortunately, accounting standards encourage companies to ignore intangible assets and instead focus on increasingly irrelevant tangible assets, which now account for less than 13% of all enterprise value. This focus on tangible assets is highly problematic. We regularly see management teams, boards and investors assiduously tracking desks, chairs, laptops, company cars and plant and equipment while ignoring materially more valuable intangible assets. The result? Many companies and investors routinely overlook significant hidden value and major hidden risks. Sometimes when I raise these issues, skeptics will say, come on, these assets are things I can't touch or see. Are they really that valuable? Take a look at this infographic from media company Raconteur. This infographic highlights the percentage of enterprise value intangible assets make up at the world's largest listed companies, along with the actual monetary value of the intangible assets held by these companies. This doesn't only apply to large organizations or tech companies, and there is a simple thought experiment you can run to test this. Imagine I gave you the heaviest, most physical, most tangible fixed asset rich business you can think of. Let's say a steel mill. But there's a catch. You don't get to keep any of the mill's intangible assets. You don't get the software that runs the mill. You don't get to keep any of the industrial know-how. You don't get the customer or supplier relationships, the data, the brand, the content, the regulatory approvals to operate the mill or release pollution, or any of the confidential information. What quickly becomes apparent is that the steel mill is valueless without these intangible assets. In fact, regardless of what the balance sheet says, the physical steel mill itself is not an asset. It is in fact a liability. The real value in the mill is the ability to run it safely and efficiently, and all of that is contained within the intangible assets. The lesson: ignore intangible assets at your peril. Even in the most tangible looking companies, the real value and ability to generate economic returns will be driven by the intangible assets.